a mistake people make is when founders are like kind of hesitant to share a lot of details and information when they're pitching. And like, I get it. I get you don't want people to like steal ideas or whatever, but so much of this, especially in a market like this, when it's not like crazy and frothy and everyone's, you know, kind of throwing money around, like building trust is so important. And so that I think a good way to like build trust with investors is to overshare information.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Michael Cardamone with us. Michael was one of the first 30 employees at Box in a business development role. After 6 years in operating roles, he launched Forumvc. He is also an angel investor at a dozen companies, including a seed round at Flexport. Forumvc now runs an accelerator, a VC fund, and a venture studio. In this episode, we talk about the story of how Forumvc got started, operating an accelerator, a VC fund, and a venture studio in tandem, what goes into running an accelerator and a venture studio, his biggest learnings from investing in startups over the years, and lots more. So without wasting any time, let's dive straight in. Hey Mike, so good to have you on the VC 10X podcast. How are you doing?
I'm doing well. Thanks. Thanks for having me. I appreciate it.
Yeah, pleasure hosting you. And we'll talk about all things Forum VC. But before we do that, let's first start with your story and how you started investing.
Yeah. So I came from a very entrepreneurial family. My grandfather had a business. My father had a business. I was working for my father's business for a little bit at a school, which was a national small business association. So I got to work with a lot of really, small businesses, mom and pop businesses, which was fun. But I realized like I really enjoyed working with business owners, but wanted something that could scale a lot more. And so got fixated on kind of getting into software and tech and wanted to move out to San Francisco, and finally moved out in '08 and got pretty fortunate. Ended up at Box when it was like 25 people, and ended up kind of funny story of like I came from New York City. I had no idea what to expect getting into tech, and like everyone in New York wore suits. So I showed up to my interview with Aaron Levy in a suit, and he asked me if I was going to the prom after the interview. So it wasn't the best start to the interview, but I ended up getting the job. But anyway, spent some time at Box. I went to another startup in the ed tech space that we grew to like 24 million revenue. And while I was in tech over that like kind of 6-year period in operating roles, I became kind of obsessed with the idea of getting into venture. And I started doing a little bit of angel investing. I was doing some consulting to companies, and I started interviewing for venture funds for associate roles, and realized like, it was just really hard to stand out. It was really hard to kind of break into. There weren't a lot of, especially back then, like in 2012, 2013, there weren't nearly as many funds as there are now. And it was becoming apparent that it was increasingly difficult to break into. And me being very entrepreneurial and coming from that type of family, I decided like, you know what, I'm just going to start my own fund, even though I had no business starting a fund and had very little investing experience. And I told myself like, I'm only going to be able to raise a small amount of money. And I think like the accelerator model suits me well. There were all these generalist accelerators like YC and Techstars and 500, but I felt like if we could launch one focused on B2B software, I'd built a good network of people who were early at SaaS companies like Salesforce and Marketo and Dropbox and Box and others that I thought I could kind of pull in. And I figured if I could get a critical mass of them to come in and I can get to at least $1 million raised, I would like hang a shingle up and launch and announce it and like force myself to do it. And it was a grind. I did a lot of consulting work, but like ended up getting to $1 million, did a first close, like put myself in business, and then kept raising, ended up raising like 3.5 for that first fund, and launched this B2B SaaS focused accelerator in San Francisco. Originally it was called Acceleprise. We rebranded to Forum Ventures about 2 years ago, but that was how I kind of got into it. I think part of it too was, I've done decent amount of angel investing over the years. And I think I joke with people, but it's not really a joke, is I think my second ever angel investment was in the seed round of Flexport, and they were already off to a really good start. And it gave me this like false sense of confidence that I knew what I was doing when I probably had no idea what I was doing. But it helped me like kind of get over that imposter syndrome of like starting your own fund. So anyway, so that's kind of how I ended up kind of getting into investing and starting what is now Forum.
Yeah, that's great. And now you're running multiple programs at Forum. So it's accelerator. So I believe the accelerator came first, and then came the VC fund, and then the venture studio. Is that the correct order?
Yeah. Yes. Yeah. So fast forward now, it's almost been 9 years, which is kind of wild to think about. But yeah, so we're about to launch our fifth accelerator fund, and that's still like a core part of what we do. We'll end up investing in probably 90 companies through the accelerator this year. About 3 years ago, we realized like, we're working really closely with all of these companies and helping them then fundraise. And, we had a lot of like built a lot of relationships with these companies and could easily get allocation in those rounds. And so we decided to raise a seed fund that kind of sits on top of the accelerator, where about half the deals we do are in deals that come out of our own accelerator, and half are as this like community of founders has snowballed, and mentors and corporates we have relationships with. We see a lot of deals, and not everything's going to be at the exact right stage for the accelerator. So wanted some flexibility to invest outside the accelerator as well. And so now we're investing out of our second seed fund, and then yeah, the venture studio is new for us, so we launched that this year. And we can talk more about that, but the goal of that is to kind of start companies from scratch out
Yeah.
of the venture studio.
Yeah, absolutely. So let's go step by step, right? So first comes the accelerator, right? So what goes into building an accelerator? While there are, the popular accelerators like Techstars, there is a YC, and each one different in its own way. So how do you kind of when you thought that, okay, I'm going to build my own accelerator, then what goes into it first thing, and then how do you think about differentiation, that how are we going to stand apart from maybe YC or Techstars, right?
Yeah, yeah. So the approach I took was um, we wanted to be kind of three things. One was being very focused around B2B and like go to market specifically. Like, how do we help B2B companies kind of leverage our experience collectively, not just mine, but like all the people we pulled in from the beginning. And I can talk a little bit about that, um, to like really help like accelerate kind of that go to market motion to get from zero or very little customers to some meaningful early traction, and then help them fundraise after that. And then can we do it in a way that's like much more hands on than maybe some of the other accelerators that do a much higher volume? And so we wanted to keep like the MD to company ratio really small. MDs usually only work with like 10 or so companies at a time, so we can like really be an extension of the founding team and like get in the weeds kind of tactically around go to market and product and strategy and fundraising and all that stuff, but also like kind of be like just you know therapists, emotional support, like all the things. It's hard being a founder at that stage, and like you go through a lot, and it's an emotional roller coaster, and all kinds of things kind of pop up. Is this going to work? Is it not going to work? Like, this customer just bailed on me. Like, all it's hard, and people don't talk about the hard stuff enough. But like, we wanted to like really be there for our founders, and build that like deep relationship. And my personality is like, I'm not much of like an outward facing kind of marketing person. I don't have like a brand marketing background. And so my thought from the very beginning, and it's still like a big kind of culture and mantra within the company, is just like be maniacally focused on founder experience and have that be like a core KPI that we focus on. And the thought is like, if we deliver an amazing founder experience, like over time, that will organically help build the brand and reputation and build credibility. And I think it took a lot longer than I thought. Like, it was certainly a grind building this, um, but it's, I think, really starting to pay dividends. And we don't always get it right, but I think we get it right the vast majority of the time, and can like really be a meaningful partner for our companies. And I think that helps then drive more companies wanting to work with us because they hear great things from our existing founders.
Right. I love it. So just to clarify, so when you started out the accelerator, did you do it out of your own personal funds at first, or did you start out having a concept and then raising a fund on top of that, then starting out? Yeah.
Yeah, no, I mean, I put a tiny check in of my personal capital, but I raised $1 million mostly from external people. And the way I did it was like, I'm only going to do this if I can get a critical mass of like great operators and executives involved. And so I went to people in my network who I thought would be really helpful. And I initially got three people who like really bought into it, and mostly were like willing to bet on me and put like kind of an irrational amount of their time into it. And so I made them kind of part-time GP. So that was Nick Mehta from Gainsight, Karen Page, who was my boss at Box, who was like the seventh employee there, and Rowan Trollope, who um, at the time was an exec at Cisco. Then he was the CEO of Five9, which is a public company. I was the CEO of another late stage private company. But the three of them agreed to kind of come on board as like part-time general partners and like really put, they each put a check in, but it was like they put their time into it and like helped me like really like help win deals and get help support founders and make intros for them. And like, because it was just me for the first couple of years and they were instrumental in getting it off the ground. And then it kind of snowballed from there. So then I got other executives like Teen Zuo from Zuora and other early Salesforce people, early Marketo people. And so was able to kind of pull together this like group of really good SaaS executives that added kind of instant credibility to us, even though we were unknown in the market, because of the caliber of people that I got involved initially. And then, like I said, once I got to like $1 million raised, I did a first close and like announced it and forced myself to like, okay, now we got now we got to do it. And then ended up kept raising and ended up pulling in, like I said, I think it was 3.6 million was where the first fund ended up. But and that fund is now, we've returned 3x cash and it's marked another 3x and growing. And so it ended up, being a great return on the fund and like ended up being a great outcome for Nick, Rowan, and Karen for the time they put in. But yeah, immensely grateful for how important they were to helping to get it going.
Yeah, absolutely. And to any accelerator, there is an important aspect to it, which is mentorship, right? Right, the kind of mentors you bring
Yeah.
in, and then not just bringing in the mentors, but also how are they helping out the founders who are there in the program. So, like you said previously in the conversation, that you got in some mentors who are also working at senior positions at some of the startups, right? So when you bring in these people who are also having a day job, then how are they also helping these startups, and how is that basically, how does that work out? That's what I want to understand.
Yeah, yeah, we do. So everyone's a bit different depending on like how much time they have, how much time they want to put into it, and what their goals are of being a mentor. I think everyone has the kind of different motivations and goals for doing it. Some people do it because they want deal flow for angel investing. Some do it because they want to find opportunities to be formal advisors, and so they view it as a way to do that. And some do it just because like they want to give back because they feel like they got a lot of support along the way, and they just want to give back. And so I think it depends on bandwidth and motivation for how they get involved. But we get people involved in multiple different ways. So one is we bring some people in to come and do like roundtable discussions on various tactical topics where a bunch of our founders can come in and it's like a group setting and they go over, demand gen or pricing or like some tactical topic that's relevant for a bunch of our companies. We do office hours where they can say like, hey, I'll give you like a 2 hour chunk of time and why don't you match me with founders that you think I could be particularly helpful based on my skill set and connections. And then people can go in and book 20-30 minute time slots with them for one-on-ones. And so that's another way. And then third is we try to like find a mentor or two for each company that comes into the accelerator that we think will be like particularly helpful for them, and we match them to that mentor. And then that mentor usually does like one call every 2 weeks or one call every month with them during the program. And some of those end up turning into like more formal advisory roles over time, but that's up to the founder and the person if there's like a fit there. But we try to just do that matching. And some of our mentors say like, hey, I just want to be matched with one company. Some say I want three, some want two. So it just depends on how much time they have and what they want to do. But yeah, and then we just go out and try to find great operators that we think kind of solve for missing skill sets or missing networks or like helpful networks for our companies, so that they can either be like really helpful on the intro front or really helpful tactically as they build the business. And so we're pretty thoughtful around approaching operators that we think can be particularly helpful for different companies.
Yeah, that's a great approach. So is this a remote accelerator or is this in person?
So yeah, pre-COVID, we were mostly in person across San Francisco, New York, and Toronto, and then we occasionally made exceptions. And now it's the other way around. Now we're like mostly remote, and then we occasionally have people who are like happen to be in one of our core cities, and they're like, "Hey, can I come in and spend a bunch of time in person with you guys?" Um, and so, but yeah, for the most part, like a lot of the programming now, which now makes it easier to build out the operator network and mentor network because you don't have to be physically there and you don't have to ask them to come to an office. Like it's easier for people to hop on a Zoom. But yeah, most of the programming is delivered remotely. And then if a company happens to be in like New York or Toronto, the MD will do like one-on-ones in person and remote, if they're depending on where they are.
Yeah, totally understandable. Great. So now let's talk about how are you deciding that which companies you're selecting for the program, or in general, or any investment that you're making through the fund, right? So how do you evaluate that they are a good fit for the program or the fund?
Yeah, so I think in general, we're always looking at early stage, right? Like, even out of the seed fund, it's like pre-seed and seed investments. And so the accelerator is like pre-seed. Um, and yeah, so I would say, we're looking for a few things. One is like we're looking for founder market fit and like great founders. But like, what does that mean? Because every investor says they are looking for great founders, and it's so I would imagine as a founder is kind of infuriating to hear that because you wouldn't be starting a company if you didn't think you were great. So the way we think about it is like, would do we think this person is going to be really good at recruiting people? And like, would we work for them? And like, what goes into that evaluation? And some of that is like how clearly and concisely they can communicate how their market's evolving and how they fit in that market and why they think they can win. How excited do you get about like the vision? Like, do they get people kind of excited about what they're building and why they're building it and, why all that's happening? So like part of it is like communication and ability to like clearly and concisely talk about what they're doing and why they're doing it. Then part of it is like founder market fit, like what unique insights do you have that other people maybe don't have to then go start this company and solve the problem. And then three, like how obsessive are you around customers and customer validation? Like, have you done a bunch of customer validation? Do you have data points to show customers want what you're building? And even if you don't have traction, like we look for founders who like have done a lot of customer validation, have had a lot of those conversations, like understand the nuance of like how they think about buying whatever they're doing or what the problem is, how they solve for it today, what they might need to replace in like detail. So we look for a lot of that kind of stuff, and a lot of what we're evaluating at this stage, often are pre-revenue. So we're looking at the founder and how much validation they've done on the customer side. And then we obviously look at kind of the market and market opportunity. And any company at this stage, you can come up with things of why it won't work, right? So that's helpful to understand like what risks are you underwriting. But what we try to think about it through the lens of like, okay, what needs to go right in order for this to work? And do we believe that those things can go right? Like, are we aligned that like those things in the market are going to happen, or whatever shift is creating the opportunity. um and that's harder, and we try to find like, do they have data points to kind of prove that out? And that could be you know a bunch of different ways to do that, but we try to look for that, and then we look for like what's shifting in the market that's creating this opportunity. Like, is there some technological shift? Is there some regulation shift? Is there some market shift that's creating this opportunity now? So we look a lot at like market dynamics, market size, is it growing, all that kind of stuff. And then yeah, to the extent they have customers, obviously that's helpful to then look at like, how did they close that deal? Why did that customer buy from them? How much are they paying? Do the ACVs make sense relative to the sales cycle? What's the feedback been from the customer? All that kind of stuff. But that we have that more often at the seed fund level than we do at the accelerator. The accelerator is often kind of pre-revenue or very early revenue.
Right. And at the accelerator, do you have a standard deal that you're offering, or does it vary company to company?
No, we have a standard deal. It's 100K for 7.5% is our standard deal.
That's great. All right. So
Yep.
saw a recent report that you did on seed and pre-seed valuation that was done in collaboration with Stonks. So can
Yep.
you share some insights from that report?
Yeah, although I think it's already outdated, which is why we did it. Because I feel like a lot of the reports that come out from like PitchBook and Crunchbase are often lagging by like a quarter, and so we wanted more real-time data in Q4. So we did that survey, and it came back. And what was interesting is like a lot of investors thought valuations were going to go down from there. And I think anecdotally, we haven't done a survey again, but just we see a lot of companies go out and fundraising, and we've talked to a lot of companies. And I think, I think pre-revenue rounds are, one, getting harder to raise, and two, valuations are coming down. I think in this survey when we did it, I think the average and median was in that like 9.5 valuation range for pre-revenue companies, SaaS companies. And I would say now, like, we're seeing a lot of deals get done in the like 5 to 8 million cap ranges for pre-revenue, kind of pre-seed type rounds. Um, And I think there's still like a pretty big disconnect, frankly. Like I can't tell you how many founders come to us and say like we're raising 2 to 3 on 10 to 15, and then like 2 months later come back and be like, oh, we're raising like 1 on 6 now, and like like it just I think there's still this like overhang of they saw their peers raise at much higher valuations, and it's like hard to mentally kind of calibrate back down to where the market is coming to, or where it frankly is right now. Um, and I think seed investors are also just getting more disciplined around price as they see their companies now raise Series A is at much lower. Like, the days of a 20 on 100 million Series A are very few and far between these days. Like most A's are getting done at like $8 to $12 million rounds at, half of that. And so when that's happening, like it's hard to justify doing a seed at 20, right? Like, so yeah, I think it's all starting to kind of compress down on price. But yeah, in the report in Q4, I think pre-revenue companies were at like 9.5 on average, and I think post 250K plus in revenue companies were raising at like more like 12, 13, 14 million. But I think all of that is coming down.
Yeah, certainly. These are very different market conditions right now. And
Yeah.
let's also talk about some of your portfolio companies. So, since you have worked with so many companies till now through your accelerator and your fund, and now even doing that at your venture studio, so would you like to mention some exciting companies doing exciting work?
Yeah, I mean, we've got a lot. Yeah, I think one that kind of grew very quickly, given what COVID happened, was first a company called First Base, which went through the accelerator. We invested out of our seed fund, and then it was just great timing on kind of the market, and they're still growing very nicely. But then they ended up raising an A from Andreessen, a B from Kleiner, and I think part of it too is just seeing like the growth of the CEO. Like Chris, I think when he came in was certainly like very driven and like wanted to be really good, and I think he's grown so much as like a leader over the last 2 3 years running this company and building the team out, and it's been fun to kind of see his growth along with the growth of the company. um, but yeah, there's a bunch. I really like. There's a company called they were called Co-Procure. They rebranded to Pavilion, but I love companies like that where it's like a very unsexy market in that they're kind of helping local governments procure better. But she had such amazing founder market fit, like knew the market really well. It's a massive market. Like local governments spend trillions of dollars procuring things, and they do it incredibly and efficiently. And so she's making it a lot easier. And they raised the pretty big Series A from Forerunner, and are doing a lot of really cool things. People Data Labs was like one of our early companies in the accelerator that's now like Series B stage with Craft, and really, a lot of revenue and growing. Um, so there's been a bunch over the years that have been fun to be a part of and see the growth of.
Yeah, absolutely. Totally love it. And one more aspect that I want you to talk about is the new venture studio that you just started. So, what was the idea behind starting the venture studio? And again, what goes into starting a studio? Did you hire an in-house team for it, just dedicated working at the companies that you're going to start, or is it in a model that you're going to get in or hire an external founder, bring him in, give him some equity, and then operate that way? So, how does it work?
Yeah. So the way we thought about it was, you know, we we have probably 500 plus founders now in our Slack community, and that's growing quickly. We've got all these operators. We have like we're 27 people full time because of the accelerator. Like we're just a much bigger team than most early stage funds. So we have people like building these networks of operators and corporates, and as we were kind of talking to all of them, like all these ideas always came up, and we sometimes we source against them and try to find companies that are solving those problems. But we felt like we were in an interesting position to be able to start companies from scratch, where we had a lot of built-in customers. We had a lot of information around like what are the problems people are seeing, and like we want to build a platform long term and community that can what we call kind of support founders from like zero to sustainable. And so when we think about sustainable, we think about like Series A, self-sustaining. And when we think about zero, like obviously the accelerator is close there, but zero is kind of like starting companies from scratch. And so we felt like it was a natural extension of what we were doing. We started then kind of sort of incubating a couple companies off the balance sheet of our management company as like a bit of an experiment, and felt like we were, we had already built out all the infrastructure to help companies with fundraising because of the accelerator. We had like inherent kind of customers built in for certain things. And so we decided like, why don't we really do this for real? We went to our kind of anchor LPs in the accelerator and said like, hey, what if we like build out a separate kind of studio fund, build out a team to start companies from scratch? Like we think we're well positioned to execute on that. So we did that. We built out a team. I think we're 7 or 8 people internally. It's like a CTO, front end, design, venture builders, growth people, and built an awesome team out. And the way we do it is like we come up with a bunch of ideas either internally or with corporate partners, or external founders come in and they love just like spitballing, like some of our portfolio founders spitballing on ideas. And then we go through a whole process to kind of vet and validate all those ideas. And once we get to the point where we feel like we're getting really strong validation around an idea, we'll then recruit a CEO in, give them a bunch of the equity in the company to help us kind of go from like a bunch of validation, that we've done, have like an idea of what the product's going to be, have like maybe even some customers lined up. They come in and help us kind of fine tune it and shape it to what they're really passionate about. And then we launch the company, we fund it, and kind of it's a de-risked way for that CEO to come in and start a company because they've got a team to build the product. We've validated it. We've got customers lined up and like money on the balance sheet from day zero. So yes, that's the way we do it. We're kind of ideation led, and then like heavy validation, and then bring the CEO in, um, and then fund it, and then we can obviously then help them raise more capital from external investors and follow on out of our seed fund when that happens, if we think it makes sense. Um, but that's how we're running it. So yeah, we'll see. But, it's new for us. I think we're launching our first 2 companies like in the next few weeks here, out of the studio. So talk to me in a year, and I'll tell you if it's working.
For sure, for sure. Great. So you're running 3 funds now. One is an accelerator fund, one is a VC fund for the seed stage, and another fund for a studio, right? Three
Yep.
funds. Great.
Yep.
That's awesome. All right. You've seen a lot of game film. You've worked with a lot of founders, worked on a lot of problems, solved a lot of problems, built out a lot of products, or helped in building a lot of products. So, what would be your advice for founders, or what are some common mistakes that you see founders make often that they can avoid?
Um, yeah. So I mean, I talked a little bit about it, but be customer obsessed. Like, we talk to a lot of founders where they don't spend enough time talking to their customers. They don't spend enough time validating, and they spend all this time like building in a vacuum, and then they go out and realize like they built something that people don't actually really want or won't pay a lot for. And so I think just like over indexing on customers and customer validation and talking to as many customers as you can is something that we recommend to our founders, and that I think we've seen some founders not do enough of. So that's one. I think two is, there's a lot of things in fundraising that is, tricky for founders to navigate. And like, there's a lot of things that are like out of their control, a lot of dynamics within a fund that might dictate whether they're going to invest, that maybe even outside of like whether the business is good or not. And so I think part of it is just like understanding the nuances of fundraising can be helpful if you're going down that route of fundraising. And then I think just a thing that bugs me that I think is like, probably a broad thing that people make, a mistake people make is when founders are like kind of hesitant to share a lot of details and information when they're pitching. And like, I get it. I get you don't want people to like steal ideas or whatever, but so much of this, especially in a market like this, when it's not like crazy and frothy and everyone's, you know, kind of throwing money around, like building trust is so important. And so that I think a good way to like build trust with investors is to overshare information. And, my team gives me, kind of teases me about it, but like, if I'm talking to a founder and I ask like, hey, can you walk me through your pipeline? And they actually like pull up a screen share of their CRM and like walk me through their pipeline, like that, like that's like touches my heart. Like that's like, that's really what, like, you want to build trust. I want to be able to trust people I'm working with. And I think like oversharing like that is like a great way to build trust. And I don't think enough founders do that kind of stuff. And I think in a market like this, especially, building trust is critical in the fundraising process. So I think that's another thing that like I think founders should be doing more of, is like really being consciously thinking about like, how do I build trust and build a relationship with this investor to get them excited about what I'm doing.
Right. And just to add the founder side of perspective here, so I've learned that one reason why some of the founders don't prefer doing it or are reluctant to share a lot of information is because they fear that a VC might access that information and then maybe not invest, or their intention is not to invest and they are there for the information, and then they share that information with maybe a competitor that they are maybe already
Yeah.
invested in. So that's a fear they have. So it's a tricky thing to balance, right? At what stage do you share that information with the investor, right?
Yeah, I mean, I get it. And I think I just saw a VC I know tweet about
Yeah.
that
Hmm.
yesterday or the day before.
Right.
Um, yeah, I mean, look, there's always going to be bad actors. I guess the way I think about it, and I would guess the way like 95% of VCs think about it, is like, I spent 9 years building a reputation, and like the quickest way to destroy that reputation is to do something like that. So I have like
Yeah,
a
that's true.
very strong incentive not to do that. And we're like very careful. We have to be particularly careful with like having a studio accelerator and seed fund around that. So we're very careful around like transparency and potential conflicts, and like, surface those very early. And we don't share things across, the funds with the studio and things like that. Like we're very careful about that kind of stuff. Um, but yeah, I think at the end of the day, and it sounds cliche, but like, execution is everything. Like, it's hard to have an idea that's so unique no one else is thinking about it. And so I think you need to like rest your laurels on the fact that like you're going to out execute and have some unfair advantage in building your company. And like, the probability of a bad actor sharing it is pretty low, but if it does happen, like, you know it sucks. It's just terrible. But it's like, but I think the reward of sharing and building trust is outweighs the downside probability of like someone sharing some information with someone they shouldn't.
Yeah, totally get it. And now let's do our last main question before we move on to the rapid fire round. And this one is
Sure.
about what's something you have learned over the years of investing that you wish you had learned at the start of your investing career.
Yeah, it's a good one. So I think when I first started, and I look back at like the first couple of cohorts, um, I think I didn't fully appreciate how much the founder drives the outcome. Like, I think there are multiple times where I like flexed on, well, the founder's not amazing, but like I love the market opportunity, or I think like the business is really interesting. And almost always those didn't really work out. And then there were times where like we bet on a founder, even though we didn't even like the idea, and like they end up pivoting into something and like building something really good. And so I think like, one of the learnings over time is just how critical it is to bet on the founder. More so than even like, I think the market still needs to be there, but like more so than loving the market opportunity, I think the founder has to be really good. And that's really hard to assess, because it's pretty subjective and hard to know over multiple meetings like how well someone's going to execute, which is why venture is so hard. Um, but yeah, I think that's one of the learnings.
Yeah, that's a great learning. And let's now move over to our rapid fire round, wherein I'll ask you 5 quick questions about the investing
Sure.
that you're doing through your accelerator and through your fund, and you have to give 5 quick
Yep.
answers. All right.
All
So
right.
so the first one goes: what are the sectors and regions you invest in?
Yeah, region. So out of the seed fund, almost exclusively focused on North America, so Canada, US. Out of the accelerator, we're a little bit more flexible. Any geo, we've probably done like 10 to 15% international, across like Africa, Europe, Asia, and then obviously North America and Latin America as well. And then sector wise, so all B2B, but within B2B, we do a lot of supply chain logistics and e-commerce enablement. We do a lot of health tech. We do a lot of B2B fintech, and then vertical SaaS, applied AI, and kind of API first dev tool type companies. Those are kind of our 6 or 7 main sectors.
Great. And what's the typical stage you invest in?
Uh, Everything from starting companies from scratch to seed, kind of max of like a $3 million round is probably like the largest kind of round size we would get. So anything in between there. At the accelerator, it's usually some early version of a product. Um, you know, they may or may not have customers. We're usually the first check in. Out of the seed fund, it's usually part of like a $1 to $3 million round.
Right. And what's the typical check size you put in?
Yeah, so the accelerator is 100K for 7.5%. Our studio, every company we start gets 250K from the studio to start, and then potentially can layer in more money from other funds. And then out of the seed fund, we're writing like 250 to 750K checks.
Great. And where can founders apply?
They can apply through the website. We just have a form on there that people can fill out, and then they can also reach out direct to any of us on Twitter or email or whatever.
Great. And where can our listeners follow you?
Uh, LinkedIn and Twitter. I'm on Twitter, MG Cardamone, and on LinkedIn. Those are probably the 2 main areas I'm active.
Great. I'll make sure to put all those links in the show notes below. Thank you so much for coming on,
Great.
Mike.
Yeah, thanks for having me.
Yeah, pleasure hosting you and happy investing.
Thank you. Appreciate it.
Thank you.